Hi, welcome to the fifth part of the money and interest rate lecture. Basically, in this part, we will start to look the data on money and how that data is actually calculated, and basically the way money supply can be defined in the economic system and the details of this money supply concept. Basically, there are two different indicators that are used to measure money, M1 and M2. Sometimes M3 is used as a second, third option. M1 is all currency in circulation, the fiat money, the actual banknotes. The money, the banknotes in reserve are not part of M1. Only the banknotes that are actually owned by the people and companies, I mean, they are part of M1. And then checkable deposits are part of M1. So money people have in the banks officially, I mean, if in your bank there is $1 million or let's say 1,000 Turkish lira in your bank account, that 1,000 Turkish lira is part of M1. And if you have 50 Turkish lira in your pocket, that 50 Turkish lira is also part of M1. But the money bank has in its safes is, I mean, the paper money is not part of M1. Because it's something which is used to back the checkable deposits. That's why it's not included in M1. Well, if you sum up all the checkable deposits and all the paper money, they are not necessarily equal to each other. You might expect M1 to be higher than base money, although it's not necessarily the case. Because with the very money you have, the paper money, you might also buy some other assets like government bonds, for example, or time deposits, which is type of deposits. You put the money, but in order to get interest, you got a certain amount of interest, but in order to get that interest, you need to wait a month. In that case, that's not part of that money is not part of M1, but that money in time deposit is part of M2. You can still take the money out of the bank, but if you take the money before 1 month or 2 months, whatever the time is, you need to wait. You lose the interest. You won't get the interest rate in that case. For the government bonds also, I mean, similarly. So M2 is M1. Everything that is part of M1 is part of M1. Plus financial assets that are considered as near money. This time deposits are an example. Government bonds are also an example. I mean, I would not necessarily accept government bond instead of money if I got a payment from someone. But at least government bond is easily sellable in the market. So people can easily sell and get money. So in some sense, maybe it might function like money, but although it's not the perfect form of money. Or stocks of money, basically. So I hope M1 and M2 concepts are clear. To repeat it, M1 is fiat money in circulation plus the checkable deposits. M2 is M1 plus all financial assets that are considered as near money. What are the amounts of them? Basically, so this is something we have already seen. The bank reserves, they are not part of M1, they are not part of M2. M1, that's actually the data taken from Fed of sample, is one of the offices of the Fed. M1 is $2.1 billion. I mean, that's the total amount of the value of total amount of money in United States that is either in circulation or in the checkable deposits. So you adapt the value of the checkable deposits of everyone, plus you add the money people or companies have in their companies, except banks, have in their pockets. In that case. This money in circulation, money in pockets or safes is 983 billion dollar, which is uh, actually a high amount of money in the United States. This probably because it is right after the crisis when people didn't trust the banks a lot. So this is 2011, by the way. M2 is much higher. It is 9.6 billion dollars, basically. And you should note that this is, I believe, M1 is actually, I mean, a high amount of this money. This is actually the total amount of M1 and M2 of US dollar, basically. And a significant amount of the money that is in circulation is actually held also by the foreign central banks. That is seen as an external factor for the United States. If foreign countries are holding US money in their reserves, basically. From that country's perspective, of course, that's a money that is not maybe part of M1 of the countries. The central bank is holding that money. But from the US perspective, that might be considered money in circulation, basically. So that's included in this. I mean, the foreign reserves are should be included in 983 billion dollar. But since we are not seeing we are not basically studying the international economics aspects of the economics in this course because of the Corona crisis case, you might disregard this factor. Just note that that amount is included in this 983 billion dollars. Let's go down. But in Turkey, M1 is 560 billion Turkish lira, and M2 is 2 trillion Turkish lira, or 2000 billion Turkish lira. And now we should get to another concept, which is called base money. That's actually the sum of the fiat money outside of the central bank. If the central bank is holding that base money, that paper, then it is not money base. But if that money is out of the central bank's hand, then it is money base. It's part of the money base. So the money in the reserves of the banks are now part of the money base. That's the paper money outside of the central bank. That's part of the paper money outside of the central bank. The money people have in their pockets is also money outside of the central bank. The paper money, I mean, paper money or fiat money outside of the central bank. So the total amount of fiat money, which is equal to the money base, is the money in the central money held by the banks in their reserves, not central bank, other banks in reserves, central bank excluded, plus money in paper money, fiat money in circulation. In United States, base money is actually almost maybe higher than the M1, 2.6 billion, and only less than half of it is actually in bank reserves, 1,069, which tells you actually there is a problem there. Yes, it is higher than the M1 actually. Of course, I mean, when you look to bank reserves, it's just 1,069 billion, but part of the reserves might also be used to help to meet M2 type of, let's say, bank accounts like time deposits, as I said, which are just basically you need to wait if you want to gain money from those deposits. So they are now not part of M1 but M2. So this is the money base. Although usually we will think in our examples, money base will be smaller than the money supply. But if you take M2, you can see actually even for the year 2011-2012, M2 is significantly higher than M1, the base money. Also M1, but more important, the base money is much lower than the M2. Now we can start. This is the term of money and how we, I mean, the money concept and how we measure amount of money in our economic system. Now we can start to look to the banking system. Well, basically, banking system is a system which connects the people who want to lend money, they need money, which might be the initial first function of the banks. I mean, the temples, which acted like the banks. But it also in time becomes the places where people put their money is for safety and maybe also earn some money as interest after they put the money. So these are the banks. And they kind of this basic function basically might actually gives bank a special position even today, and in the past also when they were printing their own banknotes, but today also, and we will see how they do it today basically. But you can easily apply it also to the ancient times and medieval times basically. So one of their function is creation of money. So bank, when central banks print money and basically held the amount of fiat money in the economic system at a constant amount, from this fixed amount of fiat money, banks are able to create more money. So they increase the money supply above the base money amount. So how do they do that? They cannot print their own money. The amount of fiat money will be same, fixed. Well, this is what we will see in a minute. But before we go to that, I just want to introduce, in most of the countries, we also have a central bank that is regulating the national banking system, and IMF, which is kind of the global central bank, which is supporting the central banks of countries, but also at least after 1980s take the function of regulating, shaping the financial systems in the world. And well, when we, of course, banks has different functions like providing cards, also transferring the money from this place to faraway places, and has some complex financial instruments from which you can earn additional amount of money. They can guide you to buy those complex financial instruments like government bonds more easily, or buy even dollar more easily. But their most simple function is, again, they give loans, they take deposits. And we will see that we will concentrate on this most simple function because that function is how they create money also. So I just want to actually create a parallel version, a new version of this in Excel. Let me do that. Well, bank has assets, bank has liabilities. And let me do this. Well, I'm sorry for that. And then I just want for the coming parts, the middle part to be, let me do it like this way. Okay. Well, typically people put money to the banks, and the banks will keep part of this money and then give the rest of this money as loans. Well, how would this be represented in our typical asset and liability table? This is something we will see in the next part, since we are getting very close to the 15 minutes.